Welcome to Savants training on members' voluntary liquidations. What are members' voluntary liquidations, MVL? A members' voluntary liquidation, MVL, is the formal process to bring a solvent company to a close. MVLs are only available for solvent companies. Solvent means able to pay all its current and future debts. The directors are required to make a sworn declaration that the company is solvent, can pay all its taxes, can pay all its creditors, can meet all its contractual obligations. This includes its future liabilities that have yet to crystallise and will normally include closing the company's accounts with HMRC by preparing and filing any PAYE, NIC, VAT and corporation tax returns and paying any outstanding balance. It may also include settling any long-term contractual liabilities such as leases and finance agreements. Once the directors are reasonably certain that the company will be able to meet all obligations before proceeding with an MVL, a shareholders' members meeting is convened to appoint a licensed insolvency practitioner as liquidator. The liquidator will then realise the company's assets, settle any legal disputes, pay any outstanding creditors, distribute the remaining surplus funds to the company's shareholders' members. Once the liquidator has completed these formalities and received clearance from HMRC, the company will be dissolved and formally removed from the company's register. Why use a members' voluntary liquidation, MVL? An MVL is usually a good option for a solvent company which has naturally reached the end of its life. Circumstances can include when a company was set up for a specific purpose or contract and that has been completed. The business has become outdated and is now redundant. The directors, owners wish to retire and there is no one to take over the running of the business. Examples: contractors. Many contractors set up companies so that the fees paid to them for their services were paid into the company, incurring a lower tax rate than earning the fees personally. Changes to taxation law now mean that the structure is no longer available to contractors. Therefore, the company is of no further use but will still require lodging of accounts and reports at a cost. These companies also may have funds sitting in their bank account that need to be distributed to the shareholders. A members' voluntary liquidation can distribute these funds at a lower tax rate than the company could and bring the useless company's life to an end. Property developers. Many property developers set up a new company for each development they undertake. They do this as property development is a high-risk activity, and by using separate companies, they isolate the risk in that development to that company rather than affecting other developments in the group if one development were to fail. By their nature, these are single-use companies. Also, developments often have several potential long-term risks as potential claims may rise for building work many years after the development is complete. By winding the company up, another barrier can be constructed against these claims as the potential claimant would need to go to the court to reinstate the company which has no assets before they could start pursuing it. A members' voluntary liquidation is a quick and easy way of distributing any surplus tax effectively and protecting the group from potential claims in the future. Benefits of a members' voluntary liquidation. Tax benefits for shareholders. The primary benefit of a liquidation is to bring a company's affairs to an orderly closure by appointing a liquidator to deal with the formalities and for the company to be removed from the company's register or dissolved. In an MVL, the liquidation should also result in a distribution of the surplus funds to the shareholders' members. In addition, any distribution to the shareholders' members may have certain taxation benefits for them. Dividend distributions in an MVL are usually classified as a capital distribution rather than an income distribution and would therefore be subject to capital gains taxation. This has lower taxation rates than income tax, especially with the availability of the reduced rate provided by Entrepreneurs Relief. Ultimately, the availability of any taxation relief will be dependent upon the shareholder's circumstances and the prevailing taxation criteria at the time of any distribution. to income rather than capital gains tax. No further costs for the company. As the company ceases to exist and is removed from the register of companies, there is no further need to prepare accounts, lodge annual returns, and pay for professional services fees. What is the process for a members' voluntary liquidation, MVL, and how can one be arranged? Only a licensed insolvency practitioner can be appointed as a liquidator for an MVL, and you will need to speak to one who will explain and guide you through the process. In general terms, the starting point for proceedings with an MVL is that the company must have completed its business and ceased to trade, anticipate having surplus funds left once all creditors have been paid, have deregistered or be in the process of deregistering for VAT, PAYE, NIC and corporation tax, have filed or be in the process of completing and filing accounts and returns up to the date the business ceased trading, be able to pay any unpaid creditors within 12 months of the start of a liquidation. The MVL process is then as follows. 1. The directors make a statutory declaration that the company is solvent. To do this, a closing financial statement must be prepared and must be sworn before a solicitor or notary. Where the company has more than one director, the statement must be sworn by all or majority of the directors. 2. Once the statement has been sworn by the directors and within 5 weeks of the declaration, a meeting of the company's shareholders must be held. At this meeting, the shareholders' members will be asked to pass a resolution to agree to the company being placed into liquidation and to appoint a liquidator. 3. As mentioned before, the appointed liquidator must be a licensed insolvency practitioner. Once the formalities of the meeting are concluded, the appointment will be published in a government gazette. 4. At this stage, the liquidator takes control of the company and the directors' executive powers cease. The liquidator will realise the company's assets, settle any creditor claims, and distribute any surplus funds to the shareholders' members. 5. A company's assets can be distributed in specie to shareholders' members, thereby alleviating the need for them to be sold. 6. Any creditor claims that are paid after the liquidation commences will be entitled to receive statutory interest in addition to the amount owed by the company. This is currently 8% and is applied from the date the liquidation commences. How are distributions paid to shareholders? Once all the assets of the company have been gathered or under the control of the liquidator, he will pay out any creditors of the company and then, based on the respective shareholding of each member, pay a distribution of any surplus assets or funds to them. This can usually be done in a short period after the liquidation is in place. It should be noted that prior to paying out any distribution, the liquidator is obliged to obtain tax clearance certificates from the HMRC, confirming all taxes have been paid. This process can sometimes delay the payment of distributions. How does a member's voluntary liquidation come to an end? Once the liquidator has completed collecting and realising all assets, paid all creditors and paid surplus funds to the shareholders, he then lodges a final report with Companies House declaring his liquidation completed. Once this is received by Companies House, they will remove the company from the register of companies.